Okay, let's unpack this. We are diving deep today into, well, a really fascinating topic. It's right where finance meets technology, and it's shaking up one of the world's oldest assets, real estate.
Mm.
You sent over some great sources for us to dig into, mainly bits from Swiss economist Dr. Pooyan Ghamari, who founded the ILN platform. His piece is called Tokenized Real Estate, Swiss Precision, UAE Velocity, and there's an FAQ section too.
That's right.
So our mission here is to take this material you gave us, pull out the key insights, and help you understand how this whole digital innovation thing is really changing the global property game.
And, looking at those sources, the first thing that jumps out is this core problem they talk about with traditional real estate. Property holds massive value. It's tangible.
Yeah, it's like the bedrock of wealth for so many people globally.
Exactly. But here's the paradox the sources highlight. Despite all that value, it's incredibly illiquid. Just think about how long it takes to actually sell a property. Months.
Right.
Easily. Sometimes longer. And it's often cumbersome, not very transparent, loaded with fees and legal stuff, frictional costs. And all that really limits who can get involved, especially in those prime global markets.
Right. So you've got all this value, billions, trillions, locked up, but it's stuck. Hard to move, hard to access quickly. And this is where the sources get really interesting because they immediately point to tokenization as the proposed solution.
Precisely. Tokenization, as Dr. Ghamari's piece explains it, is basically converting the rights to a real estate asset ownership, essentially into digital tokens on a blockchain.
So it's not just like a digital IOU or something?
No, it's more than that. It's described as a programmable, immutable record. Think secure digital share.
Okay. And for you listening in, maybe as an investor or just curious, the appeal seems pretty immediate, starting with fractional ownership.
Yeah, this is potentially huge. The sources mention examples like a prime office building in Zurich or maybe a luxury apartment in Dubai. Traditionally, you'd need serious money to get a piece of that.
Millions, tens of millions.
Right. Tokenization lets you divide that asset into potentially thousands, maybe even millions of digital tokens.
So it brings the entry point way, way down.
Exactly. Suddenly, a much broader range of people, from high net worth individuals down to potentially retail investors, could own a fraction, diversify into types of property they simply couldn't touch before.
And the other big immediate draw the sources emphasize is liquidity.
This is the other game changer they talk about. Traditional real estate is, it's slow. The sources suggest tokenized assets traded on dedicated digital platforms could potentially shift transactions from taking months to maybe just minutes or hours.
Well, okay, that speed is revolutionary in this context.
It really is. For investors, it unlocks capital, gives them flexibility they just never had with, bricks and mortar. And think about developers, faster capital raising, maybe easier exits. It speeds everything up.
Okay, so fractional liquid, got it. But the sources are also quite clear that just creating a digital token isn't like the whole story. It's not enough on its own, particularly if you want big institutions involved or need proper investor protection.
Yeah, that's a really critical point the material stresses. Just digitizing doesn't magically solve the legal or regulatory stuff. That's where they bring in this indispensable layer. The special purpose vehicle, the SPV.
SPV. Okay, what exactly is that in this setup?
So it's basically a separate legal entity, often a limited company, maybe a trust, set up just to hold the underlying real estate asset, nothing else. And the sources clarify, when you buy a token, you're not directly buying like a physical corner of the building.
Right.
You're buying shares or a claim against this SPV that owns the building.
Got it. So the SPV acts like a legal wrapper, a container around the actual property.
Exactly. And that structure is key. It provides legal clarity about ownership rights.
Right.
And crucially, it creates what they call bankruptcy remoteness, meaning the property inside the SPV is isolated. It's protected if the company that issued the tokens or the platform itself runs into financial trouble.
So it ring fences the asset for the token holders.
Precisely. And that protection is fundamental. It reassures investors, and importantly, it makes these digital instruments potentially bankable. That's what you need to attract serious institutional money.
Right. Makes sense. So this leads us to what the source material calls a sort of strategic blueprint, combining Swiss precision with UAE velocity. It sounds like where you set up the SPV and where you run the trading platform isn't accidental. It's very strategic.
Yeah, that's what's quite clever about the model outlined in your sources. It's about synergy. Switzerland comes in as the home of precision, Why? Well, think Swiss financial stability, strong legal system, property rights, enforcing contracts, transparency.
A foundation built on trust, basically. Reliability.
Exactly. This source specifically mentions Switzerland's regulatory foresight points to FINMA, their financial supervisor. Setting up the SPV there means you're leveraging that robust legal framework. It ensures the whole securitization, defining the token rights, is done meticulously.
Okay, that's the precision part. And then you pair that with the UAE for velocity.
Right. The sources highlight the UAE's dynamism, fast tech adoption, very pro-business policies, the government drive to be a global digital hub. They point to free zones like the DIFC in Dubai and ADGM in Abu Dhabi. These zones have their own common law legal systems, specific digital asset regulations looked after by bodies like the DFSA and FSRA. Plus, you often get things like 100% foreign ownership, zero tax.
Which makes them really attractive places to launch and scale the actual digital platforms where these tokens get issued and traded.
Yes, the sources emphasize the speed and agility there compared to maybe more traditional financial centers. Plus, you get direct access to a huge pool of global capital and investors flowing through places like Dubai.
So the synergy is, you get the rock-solid Swiss legal foundation for global confidence, combined with the UAE's agile environment and digital infrastructure for quick deployment and scaling the business side.
That's the compelling combination described. So you could have, say, a Swiss SPV holding the property legally watertight, and the tokens representing that SPV are issued and traded via a platform licensed in, maybe ADGM, leveraging their specific digital asset rules and global reach.
That is a clever way to structure it. Best of both worlds, almost.
And the sources suggest this blueprint doesn't just make ownership easier, it actually enables totally new kinds of real estate finance products.
Oh, yeah. Like what?
Well, they mention things like real estate-backed stablecoins, so digital currencies whose value is pegged to underlying property assets held in these structures.
Interesting.
Or securitizing future rental income. Imagine developers raising capital now by selling tokens that represent a share of the expected future rent from a building.
So different ways to slice and dice the value and cash flows, new funding avenues.
Exactly. And the inherent transparency of the blockchain gets mentioned too. Having that auditable trail could potentially reduce fraud, make due diligence easier for investors.
And maybe even help with tracking illicit money flows. That's often a concern in high-value real estate.
The potential is there, according to the sources. An immutable ledger makes things harder to hide.
So thinking about the different players, how does this setup impact, say, the big investors, high net worth individuals, institutions?
For them, the sources suggest it opens up new diversification opportunities, ways to get yield from real estate, but crucially, with much more liquidity than they're used to in this asset class, mitigating that traditional lockup risk.
And what about from a government or policymaker perspective? Why would they encourage this?
The argument presented is that it can stimulate economic growth, attract foreign investment by offering innovative regulated products, and potentially boost financial inclusion, giving more people a chance to invest in stable, wealth-generating assets they were previously priced out of.
Okay, sounds like a lot of potential upside. But, no major innovation comes without bumps in the road. The source material surely touches on the challenges, right?
Oh, absolutely. It offers a balanced perspective. They flag several hurdles. One big one is interoperability, getting different blockchain systems to communicate smoothly. That's still developing.
Okay.
Then there's the need to build out robust secondary markets specifically for these tokenized assets. You need active, liquid venues where people can easily buy and sell after the initial offering.
And regulation. I imagine that's still a moving target globally.
Definitely. The regulatory landscape for digital assets, especially how they intersect with existing securities laws, anti-money laundering rules, AML, know your customer, KYC requirements, it's still evolving, and it's pretty fragmented across different countries. That creates complexity.
What else? Any other friction points mentioned?
Yeah. Things like establishing consistent valuation standards for these fractional ownership stakes. How do you accurately price a token representing 110,000th of a building? Cybersecurity is always a risk with digital systems. And the sources even bring up this idea of tech sovereignty, potential friction between different countries' tech regulations impacting how platforms operate globally.
And the FAQ section you sent also flagged a couple of risks that maybe aren't always top of mind.
Yes, it did. Things like changing property ownership laws in some countries, maybe new restrictions or taxes aimed at foreign buyers that could impact asset values or desirability. Also, the increasing focus on sustainability green building mandates, Older properties might need significant, costly upgrades to comply, affecting their value.
Right, so the real-world physical and regulatory aspects still absolutely matter, even when it's tokenized. But okay, despite those hurdles, the opportunities highlighted seem pretty significant too.
They do. The sources talk about the opportunity to create really bespoke investment products tied to assets that were previously just too illiquid or complex to package easily. Think niche properties, infrastructure maybe, enabling micro investments in ultra luxury real estate. Imagine owning, just a few $100s worth of a landmark building.
Just a tiny slice.
Exactly. Fostering peer-to-peer lending where loans are secured directly by these tokenized assets, potentially cutting out traditional banks, and even facilitating ESG investments, environmental, social governance, using the blockchain's transparency to actually track and verify a property's green credentials or social impact.
Okay, it really does broaden the scope. Now let's try and connect this back to some of the bigger picture stuff, the macroeconomic and strategic points that were in that FAQ section of the material, because that adds important context, doesn't it?
Absolutely. That context is key. The FAQ delves into more nuanced indicators of a potential real estate downturn. It goes beyond just, say, rising interest rates. It flags things like a sharp drop in housing starts or building permits being issued, a pullback in foreign direct investment FDI specifically targeting real estate, watching household debt levels compared to income. Even shifts in rental vacancy rates can be early warnings.
And it mentioned that gap between income growth and house price growth. If prices run way ahead of what people earn, that's often a sign of a bubble, right?
A classic indicator of potential overvaluation, yes. What's particularly interesting, though, is the source's take on de-dollarization, this push by the BRICS countries and others to trade more in currencies other than the US dollar.
How does that connect to property?
Well, the sources speculate that this could shift global capital flows significantly. If less wealth is held in dollar assets, where does it go? The suggestion is it could boost demand and potentially prices in markets seen as alternatives. They name places like Dubai, Riyadh, Mumbai, even some African capitals as potential beneficiaries if wealth seeks new destinations.
So global politics and currency shifts, potentially creating new real estate hotspots. Fascinating. The FAQ also touched on how the really wealthy, the high net worth investors, are navigating all this uncertainty. What strategies are they using?
It highlights moves beyond just buying and holding prime assets. Things like looking for distressed opportunities, sellers who need to liquidate quickly, focusing on niche property types seen as more resilient, like data centers, logistics warehouses, healthcare facilities.
Things tied to essential services or digital infrastructure.
Exactly. Also, investing in structured debt, so lending money secured against property rather than buying equity. And adaptive reuse, taking older, perhaps struggling buildings and repurposing them for something new that's in demand.
Very strategic place.
Yeah.
And central banks, obviously key players. But the source says it's more complex than just the headline interest rate.
Much more. The FAQ explains things like quantitative easing, QE, when central banks pump money into the system by buying bonds. That tends to push asset prices up, including real estate, because there's more cheap money looking for a home. Then there's quantitative tightening, QT the opposite, where they pull money out. That can cool markets down. But they also mention macroprudential tools.
Like what?
Things like setting limits on loan-to-value ratios, how much you can borrow against a property's value, or debt-to-income limits. These directly restrict lending and can curb speculation even if interest rates themselves aren't super high.
So direct controls on borrowing power. Significant. And why do these high net worth individuals still seem to favor tangible real estate, according to the source, even compared to stocks?
Well, beyond the obvious yield, inflation hedge, having a physical asset, the source emphasizes things like better geopolitical risk diversification. Owning property in stable, different parts of the world can be a hedge against turmoil in one region, maybe better than equities tied to one country's stock market.
Right.
Plus, there can be tax advantages depending on location and structure, and, a sense of direct control over a tangible asset that you don't really get with public shares.
Looking globally again, the FAQ actually named some specific cities emerging as key hubs right now.
It did. Dubai, Singapore, Riyadh, and Zurich were the ones explicitly mentioned. And the drivers listed were pretty consistent. Strong economies, political stability, supportive regulations, high demand, and crucially, lots of international capital flowing in. Zurich pops up again there, linking back to that Swiss precision anchor.
Okay. AI gets a nod too. Artificial intelligence in real estate. Is it just hype or
The source suggests it's moving beyond just trend analysis. It talks about AI shifting towards predictive and even prescriptive analytics. So not just saying prices went up, but using AI to forecast future prices more accurately, assess risk in real time, recommend the best time to buy or sell, even suggest specific renovations likely to give the best return. Optimizing whole portfolios.
So getting much more sophisticated in decision support.
That's the direction highlighted.
And finally, just touching on geopolitical instability again, how does the source frame its overall impact?
It's presented as a double-edged sword. Instability in one place can trigger capital flight money seeking safety that can boost demand and prices in perceived safe havens like Zurich, Singapore, the Gulf cities.
Right.
But at the same time, that very instability can create distressed buying opportunities in the affected regions for investors who have the stomach for risk and can move fast. It requires agility and foresight.
So navigating that global chessboard of politics and economics is now just intrinsically part of sophisticated real estate strategy. You can potentially capitalize on volatility if you're smart about it.
It seems increasingly so, yes. A dynamic approach is needed.
So wrapping this up, what does all this mean for you? We've explored how tokenization, combined with that crucial SPV legal structure, is aiming to fundamentally reshape real estate investment, making it potentially more liquid, more accessible. We've looked at this interesting strategic blueprint, blending Swiss legal rigor with UAE's market agility drawn from the material you sent. And we've tried to connect these innovations to the wider world, global economics, central bank moves, geopolitical shifts, even the rise of AI in this sector. It paints a picture of a future where property's tangible strengths get seriously amplified by digital tools. So as you think about this deep dive, maybe mulls over this provocative thought also from the source material. If transforming these traditionally static, locked-up assets into dynamic, tradable digital instruments really is key to unlocking huge amounts of capital and maybe driving more sustainable development. Well, how might the widespread adoption of tokenized real estate end up reshaping not just our investment portfolios, but maybe the very fabric of our cities and even global economic power balances in the years ahead?